Hi, I'm Mark.
And I'm Steve, and welcome to Bytes by Standard Chartered's Chief Investment Office. Priced for perfection? In financial markets, there is an inherent tug-of-war between themes or stories and valuations. We are seeing one play out in the equity markets right before our eyes, in the semiconductor industry. In the late 1990s, the internet was the craze. Truly incredible things were happening. Adding .com to the name of your company could lead to a significant revaluation of your stock prices, seemingly disregarding any changes to your business model. There were, of course, companies that actually did have strong internet-focused business models and a very strong competitive advantage.
One such company was Cisco Systems, a company that built networks upon which the internet was based. At its peak in March 2000, Cisco traded almost 7 times the price of just 2 years earlier. Thereafter, the stock price took a significant downturn, falling 83% in the next 3 years. The impact was not just short-term. From its peak on the March 27, 2000, it took until September 2021 for the stock to deliver positive returns, even assuming that the investor reinvested any dividends distributed. Today, the stock is trading almost exactly at its 2000 peak.
Was the stock's performance a reflection of the company's fortunes? To some degree, yes. Earnings continued to grow into Q1 2001, but then fell into negative territory for the next year. However, by the end of 2002, trailing 12 months earnings hit a new record high and never really looked back. Since then, earnings have grown more than fivefold at a compound annual growth rate of 9 to 10%. The challenge was not the company's long-term outlook or doubts about the future of the internet, but the fervor with which investors extrapolated that outlook. In Q1 2000, the stock's price-to-earnings ratio was over 250 times.
Fast forward to today and there is a risk we are about to see history repeat itself in another technology company. Before the latest earnings release, Nvidia's price-to-earnings ratio, based on trailing earnings, was over 220 times. Of course, Nvidia earnings blasted above market expectations for the latest quarter, and the consensus expects them to grow strongly into the future. Indeed, assuming forecasts for earnings to triple in 2024 prove correct, the price-earnings ratio would be a mere 45x.
Valuations are rarely a useful predictive indicator for short-term market performance. However, it does suggest that investors should be aware of the risks of a semi-permanent loss in value if they invest at current prices. So how should an investor operate in this environment? It is always critical to right-size any investment, but the narrower the investment, the more important this becomes. We view investing through two lenses: foundation and opportunistic.
We would place single stock holdings, especially stocks with the likelihood of significant volatility, in the opportunistic bucket. Investors should ask themselves how they would feel if the stock went down 20%, 50%, or even 80% and then recovered only after decades. What would their brain tell them to do?
If the answer is sell, which is more likely, then a limited exposure to the stock would make sense. It should not be viewed as part of a foundational portfolio, but more as something on the opportunistic fringes, with the allocation accounting for a small fraction of the investor's overall diversified portfolio. Thanks for watching. See you in the next episode.